Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, October, not the 10th. I think it's the 9th, isn't it? That's fine. We're ahead of time here. Yes, it is the 9th. Sorry about that. Somehow it's a Wednesday that feels like a Thursday, I guess. Anyways, the bulls remain in charge. The pullbacks continue to be very shallow, and our ending diagonal path continues to play out. That has been our preferred path. And I hope you appreciated the analogy that I wrote on why we use alternative wave counts as a insurance policy, because when you have a car, you also have a insurance policy. You hope you will never have to use it. Most people do use it because it's never certain once you get into your car, you will get from A to B unsketched. And that's just there to protect your assets. It is there to protect your health. It is there to protect your property. And the same with alternative wave counts. They are there to protect your hard-earned money. Okay. And that's really all there is to it. And driving around uninsured is not a good solution. That's what happens when you don't pay for a subscription. That's what happens when you don't hire a professional. It's the same with legal. It's the same with healthcare. It is the same with car maintenance. You can do it yourself. Maybe you're very handy. And maybe you can go to the court and you know the rules, and maybe you can heal yourself. It's all great. But most of the time, we have division of labor, meaning we professionalize and specialize into something so we can help somebody that does not have the time to specialize and professionalize into something. That's really all there is to it. Do not get confused with, oh, we're saying it goes up or down. Technically we are, but we prefer a certain point of view and contingent on holding above certain price levels in this case. And I'm not saying this to my current members. I'm saying this to those that are listening through a video on YouTube eventually. If I post this, sometimes I do, sometimes I don't. But if it's on YouTube, it means it's for free, and it doesn't necessarily mean you will get it in time. Most of the time, you get it too late. Well, that's on you. My members get it first, and thank you, members, for being members. Highly appreciate it. And let's go straight to the charts because we have technically a breakout on most indexes. So I'm going to just go in alphabetical order. This is the Dow Jones, and it looks like all we got was a B wave low at last week's low, and we're now in this wave C. And stock chart, once again, tends to screw up the labeling. A CSA relationship points all the way to about 44,000, believe it or not. But that is no real surprise, as that is still within our ideal upside target. Let me show you the chart for the Dow Jones on the weekly basis. And that one you've seen many times now, of course. That is the regular chart, no annotations, with our target zones all the way up to 44,139. Okay, and we can go even much, much higher, of course. We don't have to adhere to these. But I have no signs of a top being in place. It starts to look like some of this negative divergences is being erased. I still believe we are in 5 of 5 of 5, etc. Okay, so as you can see, we are in this ideal target zone, and we can easily go to 44,000 plus. And so far I have zero indication that we're not going there. So let's put this one on the map. We are not below any break down levels that are warnings for the bulls. So the bulls remain in charge. Let's go to the NASDAQ 100. And let's first start with this one. Here, as you remember, we have been wondering if the December low was wave 2 or if the March low was wave 2. Why? Because the December low retraced almost all of the rally that started in October into early December, late November. Was this a leading diagonal, or was this still part of the bear market of 2022? It starts to look more and more that that was still part of the bear market in 2022. So we have a 1, 2, 1, 2, 3, 4, 3, 4, and now in 5. That is now our preferred view, with, of course, the caveat that if we break below certain key levels, we can go to the alternative, and that is that we have a larger protracted B wave. This one is still on the table. It is still possible, but this starts to look bullish. Okay, so this is our preferred wave count of a also ending diagonal. Here you see the C is a relationship, or 3 is one relationship, targeting the 123.6% at 21,500. This is exactly where the 1.236 times 1 slash A or B from B/2 is, which is a typical C3 target zone. Why do I label it like this? Because we don't know yet if we're going to get a 4 and 5. And sometimes diagonals really just look like 3 waves with a very tiny little 4th wave snuck in. Not to the extent as we saw here from August into September, but maybe just a few days. It could very well happen. I don't make the markets. So that's why we tentatively label 4 and 5, because we haven't seen them, so we don't know yet if they're going to happen. Most likely they will, but let's not wonder about that yet. For now, as you can see, we have a new uptrend closing high, and I believe we are in this C/3 all the way up to 21,499, contingent on holding above the warning levels. The first one is today's low. Okay, the second one is, of course, last week's low. That's the B/2 now. So we had a 3-day pullback, which was a nice ABC. And we should now be in a new impulse, potentially just also an ABC higher. C is A, or 1 is 3, equals at 21,500. So I think we can target it, contingent on holding at least above 90,600. If we break above that Fed Wednesday low, right, at about 90,300, all bets are off. Those are the warning levels for the bulls. Let me add that to the chart. If stock charts decides to finally respond, but you get the idea. So warning levels for the bulls. And that would then leave us with the wave 4 low here. Now, this wasn't 5 waves lower, as it can be counted that way, but then it was 3 waves lower. Okay, A, B, C. We could count it as 5. 1, 2, 3, 4, 5, 6, 7, 8, 9, which is an impulse. Or it is 1, 2, 3, 4, 5, 6, 7, which is corrective. Then this was all of part of a irregular flat wave B. And now we are in wave C/3, and we can target as high as 22,500 for wave 5 after a pretty steep wave 4 pullback pending. Remember, we're going completely contrary seasonality. Seasonality has us, of course, bottoming somewhere late October, most of the time down in September into October, and that has not happened. Instead, we've been rallying with only 3-4-day pullbacks at the most. So then this was not wave 2, then our interpretation was wrong. And remember, if you get the 1-2 wrong at the beginning, you will get the 3-4 wrong at the end. Again, it's interpretive, but once you've recognized the problem, you deal with it and you move forward. With the alternative, of course, this one. And I'm not going to put warning levels for the bulls here anymore. I'm going to put this for the bears, of course. And because we have the one for the bulls, a new all-time high, and we're definitely going to go. So we have now breached and, of course, reached the previous uptrend high, and any all-time high going forward, we can fully focus on our preferred wave count. It still remains our preferred one, right? This is simply our insurance policy. Even my ETF trade alerts went long, a short-term, the NASDAQ 100, and I'll adjust this wave count. As you can see, the pullback here just barely reached the 38.2% retrace. And that is the minimum. Well, 23.6 is pretty much the minimum, but this is normalish for a B wave. You saw we missed it by maybe 100, 200 points on 19,500. It's not too much, but it shows you that, okay, well, that was again a bare minimum pullback, just as the Fed Wednesday low was a bare minimum pullback. So then we move the A and B label here, and we did not get a breakdown. Remember, we said we're going to go to 90,400, 90,100, contingent on breaking below this low. Okay, that was, of course, what we were looking for. Well, we didn't, and that was it. So we never got this breakdown. We got just barely a 38.2% retrace. And remember where we are in a technical trend perspective. It's a 100% bullish chart. So now we can target 20,600, 700 for a retest of the all-time high. If we make a new all-time high, then of course this cannot be a B wave, and the C wave will not follow. So you cannot prepare for this C wave, right? We cannot prepare for it. You cannot front run it. Only, as I have stated many times below the September 6th low is when you go for that trade. You cannot do it now just because we have it as a potential, and even a alternative potential definitely means you should not trade it. You always trade the preferred wave count. And I've stated that a million times before. And unfortunately, we'll have to repeat it a million times. For those that listen live on YouTube and don't understand how the Elliott Wave works, because Elliott Wave is still the most powerful way to forecast the markets. It's not infallible. Why? Because it's interpretive, of course, and I'm not perfect. And the market is quite tricky. It's me up against millions of people. That said, I think we're doing a great job, and the pullbacks are shallow, and we have new highs preferred. That was our preferred point of view, and I'll show you that for the S&P 500 in a moment. Semiconductors, again, we still have that gap here at 5650, 5700, and it really looks like this is going to get filled. Now, last week's low didn't even make a normal CSA relationship. Again, we don't make markets. Sometimes C is 0.764 or 0.618. So I'm going to place the label of the C wave right there, last week's low, as you can see. Quite nice. At a little bit over 38.2% retrace. This is quite normal. Okay, nothing too bad. It doesn't have to be 61.8. And as you can see here, a CSA relationship can target as high as 5,800. Okay, so not a problem. Plenty of upside left here. So we had a pretty decent B wave pullback, and that's the CSA relationship. Again, C doesn't have to be A, as we showed here. Here, C was, I think, 0.764 times A. Can happen. Again, we cannot predict the future. We cannot know exactly if that's going to be the case. So let's look here at the length of, that was 0.764. Yeah, on a, about there, 88 something percent. Okay, well, that's it. That's all we got. That's bullish, and bull markets downside disappoints. So now we can raise the warning levels for the bulls a little bit. Today's low, of course, is the first warning. The second warning, I would say, is going to go below this day here, which is the top of the A wave there. That's the second warning. The third warning is, of course, this low here. And the ultimate warning remains the September 6th low for now. Okay, so these are the warning levels for the bulls for the semiconductors. A little tighter than, for example, the NASDAQ, where we had the third wave warning, or the third warning at the Wednesday low, when the Federal Reserve decided to lower the interest rates. The alternative is that we did top for this B wave, and we're going to go lower. Again, look at this. We're almost at the fourth warning level for the bears. So look also where prices in relationship to the moving averages above the 10, the 20, the 50, the 200 day. You can see if we add the Ichimoku cloud as well. Let's do that 1.3. So it's not too much. We're above it. At the upper Bollinger Band, it looks like a hop in a scotch to break over the A wave high from September, and then we're off to the races for this 5,600 level at a minimum, in my humble opinion. So I'm going to look for these higher levels, contingent on holding above these warning levels, with a first warning below today's low, a second warning below, so today's Wednesday, Tuesday, last Friday's low, and a third warning level below last, is that Tuesday's low? I believe so. This one. Okay. Why? It's of course an important candle, and it's been completely been bought up. Excellent. So far, so good. Let's move on to the S&P 500. Yes, a breakout, a new all-time high. This is not bearish. Again, we have, of course, positive divergence on the MACD, meaning that price went higher and the MACD as well. And we only got a 23.6% retrace, I believe, for this B wave, ABC lower, and no follow through. My ETF trade alert system tried to go into inverse ETF, just a 25% size position, and both got stopped out. And now we're back to long. So, you know, it's like your insurance policy. Hey, if it wants to go lower, probably we could have made some money. It didn't. Well, then we have a couple of losing trades in a row. Also for the Dow Jones, I think we had like 4 or 5 losing trades in a row due to this very sloppy price action. It happens. It's okay. Bigger picture wise, we'll still be fine. It's all about the long run because trading is a marathon and not a sprint. So our preferred upside target remains 60.57 for a CSA relationship. All right. We've raised the warning levels for the bulls accordingly, and we did not get the breakdown. I showed you earlier, I think it was on Monday, that a break below last week's low could target somewhere around 5,500, 5,600 plus or minus 50. It just didn't happen. Okay, that was it. Didn't happen. So now we must be bullish and at least target symmetry at around 58.40. You see this black box? This is where price has been in for quite a while. And if we break above it, like we did today, and we hold the breakout, we can target 58.40. And I think the ideal upside target CSA is 60.57. That's what we're going to gun for right now. But we're going to raise our warning levels accordingly to tell us, are we going to get there, yes or no? For now, this ending diagonal path remains the preferred path. We've had it for weeks now. I have not seen many people actually carry it yet. I'm sure they will eventually copy it as they recognize it. But so far, so good. So we stick with it. The alternative is that we have completed wave B. We're right at the 123.6% extension of the green wave A at wave B. This is our insurance policy. Don't like it too much. You know, we broke above the previous all-time high. That's bullish. Okay. So then we have to, of course, break below the warning levels for the bulls, at least today's low / open, then last week's low, and then, of course, below the Fed reserve low to really tell us this is the case. This is our insurance policy. I don't like it, but we got to have it. Nobody likes insurance policies because it feels like you're wasting money, right? You're paying and never using. Well, once you use it, it's really good. My wife last year or this year totaled her car by accident at 15 miles per hour. Believe it or not, she rear-ended somebody who brake tested her, and the car got totaled because all the airbags went off. And insurance companies these days don't really want to get the car fixed with new airbags because of liability issues, and it's quite expensive. So even at 15 miles per hour, you can total your car. You can go, what kind of crap car is that? Well, it was a Nissan Maxima, 2000, I think, for 20. So a really pretty new car, and just all the airbags went off. That was it. Okay, it happens, and I don't know what else to say than, you know, then your insurance kicks in and she got a very good payment out of it. So then you can buy a new car, and she went for a Beamer. Well, that was done with Nissan. Hopefully the Beamer is safe. Anything other than accidents can happen even if it's not your fault. All right, moving on to the IWM. Last but not least, this is our preferred wave count that we've bottomed for this B wave. Also here right at the upper end of the target zone. And now we need to see follow through and break, of course, above the 225 level for things to move higher into the 250s, okay, for this path. This is our preferred path, contingent on holding above the warning levels, which we have done so far elegantly. Other than breaking below the first warning level, we're back above it. We have not even broken below the second, let alone the third, or even the fourth warning level, which remains the September 6th, okay? If anything, we do not recommend selling, but we cannot make any trade recommendations. And the alternative is, of course, this 1-2 setup. Again, I don't like it because of this very unorthodox top. This has always been our alternative. And for now, I don't see it. This doesn't look like 5 waves lower, at least not now. Can always change into a diagonal. But otherwise, we prefer to look higher. So I hope that rings home, and it's worked out pretty well. This was quite a mess here, the Dow Jones. These are these corrections, a time versus price. Like this is a correction in price, rapid. So you get rid of overbought conditions. This is a correction in price. You get rid of overbought conditions. This has been a correction in time. So also gets rid of overbought conditions. Okay, the conditions have gotten overbought on price and as well on market breadth. Quick look at market breadth, for example. Don't really see anything too noteworthy. We have to keep an eye on the AD line for possible negative divergences, but we just recently made a new all-time high, so that's bullish. Let's look at the new lows, for example. This is still benign, 29 for the NYSE. It's nothing to Right, home about MO index is negative, as you can see. So that's not a good sign, but we got as low as minus 60. So that has caused the summation index to be able to get rid of all of its overbought conditions. We're still in a sell signal. That's something else. But now we have plenty of room to go back up again. And remember here, early in 2024 and in the middle of 2024, when the market grinded higher with negative market breadth. And it seems like third time is the charm. We're doing it again. But this is an excellent way to get rid of overbought conditions. And that's what it's been doing. And then last but not least, the PMO index is bottoming out right now. It did get rid also of its overbought conditions. So also this one has now room to improve. Okay, so far so good. We remain bullish as we have been. Pullbacks were very shallow. We did not see any breakdowns. This price section, of course, is hard to elucidate exactly what it is, but this looks corrective. If anything, this is corrective, and we should still see higher prices. So I'm going to look here for 43,778 to 44,987, which matches some of these bigger picture upside targets for the Dow Jones, because we're not breaking below any of these warning levels. Once we do, you'll be the first to know. NASDAQ should also now move higher. Remember the wave count. We are slowly moving it, the alt to the preferred. And that is that the wave 4 bottomed, and that the 2022 low was not in October, but in December. Field, fifth. First target, 2,600, 2,700 for a potential B/2. But also here, we're still looking higher. We're above the 10, the 20, the 50 at the upper Bollinger Band, so we prefer to be bullish. Same for the semiconductors, minimum target at about 5,550. Potentially as high as 5,800. Alternatively, we're going to fail miserably, but we still need to see price drop at least below last week's low. Okay, and S&P 500 the same, needs to break at least below last week's low, and even below the Fed Wednesday low that was mid-September on the interest rate, and ultimately the September 6th low. I can't hammer down enough. September 6th low, Fed Wednesday low, last week's low. Those are the stair steps the bears need to take, and maybe wake up with a big fat red Thursday tomorrow. It's always possible. For now, the charts are not forecasting this at all. So we have to remain bullish until proven otherwise. Take care, trade safe, and I'll catch you all later this week.